Ladies and gentlemen, welcome to another episode of the Diligent Investor Digest. In today's episode, we're going to be going over some of the key takeaways from the Bank of Canada rate decision announced yesterday. As always, you can expect no-nonsense insight and for us to uncover the truth that no one else is willing to tell you so that you can make better investment decisions. Hi, and welcome to another episode of the Diligent Investor Digest, a channel that hopes to empower the everyday individual to make better investment decisions. In today's episode, we're going to be going over some of the highlights from the Bank of Canada interest rate announcement yesterday. I did do a reaction video on the announcement. I was hoping to react to the whole complete video. However, the video I was using for it, the CBC video, I believe, it was cut off, so it wasn't actually the whole thing, and even then the reaction turned into almost an hour. So if somebody wants to watch that, please go ahead, click on the full review. In this video, we're going to be going over just some of the highlights. So to summarize the meeting, Tiff Macklem once again came out and laid out a rosy outlook for the future. This, he keeps doing this. So in 2022, the outlook was basically like, in the latter part of 2023 and 2024, things are going to be better. In 2023, it was the same thing. Basically, pushing the target down the line, saying, oh yeah, things are going to get better in a little while, and then we'll be thinking of cutting interest rates. And in today's announcement, basically it's nothing, nothing's different. Tiff Macklem is claiming that monetary policy is working, that the economy is about to get better, and then they're almost ready to cut rates. Now, if you're watching this channel, of course, you are perfectly aware that that is not true. The Bank of Canada is not in a position to cut rates, even if they wanted to. And believe me, they really, really want to cut rates. There is a lot of negative economic data coming out that usually calls for a central bank to step in and start regulating monetary policy. But because the Bank of Canada now has absolutely no ammunition left, Tiff Macklem has absolutely no choice but to basically deny reality and tell you that, the grass is blue. So without any further ado, let's get to our first clip. This is Tiff Macklem basically summarizing the 3-point message that he has for Canadians.
Our policy interest rate at 5%, and we're also continuing our policy of quantitative tightening. 3 main messages this morning. First, monetary policy is working. Total CPI and core inflation have eased further in recent months, and we expect inflation to continue to move closer to our 2% target this year. Second, growth in the economy looks to be picking up. We expect GDP growth to be solid this year and to strengthen further in 2025. And third, as we consider how much longer to hold the policy rate at the current level, we're looking for evidence that the recent further easing in underlying inflation will be sustained.
Okay, so that basically summarizes his speech. He went on to elaborate on that basically quite a bit, painting this rosy outlook that, things are good right now and they're almost ready to lower rates, we just need to wait a little bit more. And if everything stays good, then they're gonna lower rates. So this isn't the first time that Tiff has made such a rosy outlook. He's been making these predictions going back to 2020. None of them have panned out. Things always work out basically the opposite of what he lays out. Now, in the whole meeting, Tiff Macklem kept playing with the idea that they are about to lower rates, and maybe sometime in June, if he has confidence that inflation is under control, then they'll be in a position to lower rates. Of course, if you've been watching this channel, then you know that I am of the opinion that the Bank of Canada doesn't have the ammunition to lower rates. Not only that, they will probably have to raise rates given the larger economic environment of global wars that we're going through right now. So Tiff spent the whole meeting avoiding the topic of raising rates. That wasn't even mentioned at all. And I got to give credit to Greg Quinn, somebody I haven't heard about, but Greg Quinn was actually one of the questions posed that mentioned that the Bank of Canada has revised one of its estimates for interest rates higher. They call it the neutral rate, and that estimate did go up by 25 basis points. I thought that was an excellent question to ask Tiff Macklem, and I will let Tiff answer it for himself.
Thank you for that. Let's go to Greg Quinn from Market News, please.
Good morning. I was wondering about the slight increase to the estimate of the neutral interest rate. Is that any kind of barrier to how fast you can cut interest rates? In other words, is it any kind of a hard floor or a squishy placemat?
Greg, what I would emphasize is that, first of all, the neutral rate is not something we can observe directly, and there's a lot of uncertainty about it. We do estimate it, and it's a necessary input in our models, but it's not something that really has much of influence on real-time monetary policy. I mean, in real time, we're much more focused on where's inflation headed, what do we need to do to get inflation back to the 2% target? What do we need to do to maintain it? I mean, the neutral rate is, it's a theoretical concept. It's you want to think about it. The neutral rate is where our policy rate would be in the long run when inflation's at target, the output gap is closed, and there are no shocks. Well, of course, we'll never actually get there. In your forecast in the future, there's no shocks because you can't forecast shocks. But of course, when we get to the future, there will be shocks. So yes, it's something we need in our models, and in being fully transparent, we publish the core assumptions underlying our models. That's one of them. We revise it once a year, and with our estimate of U.S. Neutral rate going up, and with some other factors, we have revised up our neutral rate by 25 basis points. It's a range. The range moved up 25 basis points. Is that having a very big impact on our deliberations in real time? No.
Okay. Okay. So thank you, Tiff, for that. There was actually a lot in that answer. So first off, he said, he tried to explain what is the neutral rate. So the neutral rate, basically in his words, is if everything works out, that's where interest rates are going to go. And that kind of contradicts, his opening remarks and the rest of the meeting, where he's saying, well, if we see the economy going well, then interest rates should be going down. So that was the first thing. Secondly, what I thought was really interesting is him talking about how, well, we can't forecast shocks. Obviously, shocks are going to happen. That was really, really interesting. So he's well aware that all of his rosy outlooks and prognosis absolutely does not take into account any of the larger, of the pretty big risks that we have going on right now in the world. The most obvious and big one is war. So I think it's really important to understand what he's saying. He's basically saying, yeah, our rosy outlook is, our rosy outlook is built on the fact that there won't be any shocks in the world. And as he pointed out himself, obviously shocks are going to happen. So things are not going to work out as he's planning. He already knows it. So it really calls into question, what the point of these outlooks are. The main takeaway for me is, these guys behind the curtain, they already know that interest rates are gonna continue to increase, and with the added shocks from the global environment, these rates are gonna continue to increase even more.
Okay, Anna Pereira from the Toronto Star. If you have a question, please come off mute.
Thanks so much for taking our questions today. I want to know, how are you evaluating the impacts of the policy interest rate on shelter inflation and its effect on overall CPI?
Well, first of all, shelter inflation is high. It's the biggest contributor to overall inflation. Shelter inflation, 6.5%, and that really reflects two big pieces. One is mortgage interest costs, which is directly related to the fact that we've raised our policy rates, and that has had the impact of raising mortgages. That's how monetary policy works. And then the second element that is particularly elevated is rent. Rent is in February increasing at a pace of 8%. So how does that factor in? There are some other bits of shelter too, insurance costs, repair costs, things like that. How does that factor into monetary policy? Well, I'd underline two things. First of all, our target is for total CPI inflation. That includes shelter, and that reflects the fact that look, shelter is a real cost for Canadians. It's a very important element of their cost of living. So when you're targeting 2% inflation, that's not something you can ignore. Having said that, we know that our policy actions directly affect mortgage interest costs, and we know that when it becomes appropriate to reduce the policy interest rate, those mortgage interest costs will start to come down. So we know, that is something we can control for as we think about our monetary policy response. I've emphasized that we're particularly focused on core inflation. And one of the things our measures of core inflation have been doing is that if you look at the trimmed mean measure of core, it has been systematically kicking out mortgage interest costs through this whole rate increasing cycle. It has not typically been kicking out other elements like rent or other elements of housing. And that's largely appropriate. I mean, the increases we're seeing in rent suggests the real tightness we're seeing in the housing market. That's part of the economy. We have to factor that in. It's not the only part of the economy. We have to factor it in with all the other parts, but it's not something you want to ignore. It's not something you want to look through. By focusing on core, we are effectively, though, looking through mortgage interest costs while including the other elements of housing, which reflect there is a structural tightness in our housing market. Supply of housing has not been able to keep up with demand. That's probably going to, we're probably going to be living that. Probably going to be living with that for a while. Certainly, there's a lot more focus now on getting supply up. You've seen governments at all levels are much more focused on this, but it is going to take some time to work through that. That will continue to contribute to inflation.
Okay, very interesting answer there on real estate. So basically, he's acknowledging that, there is a problem in real estate. Real estate is appreciating a lot higher than the CPI inflation number that he's posting. Another good question that was asked of Tiff Macklem was in regards to the most recent inflation numbers that came out of the United States. And, the journalist asked, there's obviously a lot of correlation between United States and Canada, them being neighbors and the largest trading partners. So how does he expect, what does that inflation number mean to him? And that, I think, is just one of the funniest answers that Tiff gave. So without any further ado, let's hear it from Tiff.
Okay, Rob McClister, if you're there, please come off mute and ask your question.
Good morning. Canadian inflation tends to be highly correlated with U.S. inflation. The latest readings show U.S. inflation running about 70 basis points higher than Canadian inflation and rising. So could such a divergence continue for a long time? And if U.S. inflation continues shooting higher relative to Canada, should Canadian borrowers expect that the bank would be materially less likely to cut rates this year?
Well, look, the latest U.S. CPI number just came out this morning. We haven't had a chance to look at it in any detail. So, I'm not going to comment on, today's data release out of the U.S. I think, with respect to Canada, look, we're focused on where we think inflation in Canada is headed. And I think I've been pretty clear. Inflation's still too high. as Carolyn has underlined, there are a number of risks. Risks remain. But we are encouraged by the evidence we've seen recently that inflation has moved down. There is some downward momentum going forward. We're looking for that to be sustained. Yes, developments in the United States have an impact on Canada, both the strength of the U.S. economy, and we import particularly goods from the U.S., so that will spill into Canada. If you look at the composition of U.S. inflation, goods price inflation is not the issue. It's more service price inflation, which is not something we tend to impact as much into Canada. So I don't see a big direct imported inflation effect. But look, we'll have to look at this more closely. But I do want to emphasize we have our own monetary policy in Canada. We have our own currency that allows us to have our own monetary policy, and we're really geared towards what's happening inflation in Canada, and that's really what we're focused on from a monetary policy perspective.
Okay, so another great answer there from Tiff Macklem. Basically, yeah, he's not going to comment. It's too early. He doesn't know, but he doesn't expect U.S. inflation to impact Canada, and of course he reminded us that he's in charge of Canadian monetary policy, as if somebody wasn't aware of that. Okay, so one more thing. Yeah, I want to cover just one more thing. The question of risks did come up. Nobody asked explicitly about war, but they did ask about delayed shipping and kind of things like that. So that's another question that I thought was really good that I want to play for you right now. And let's hear the answer.
We're now going to go to Max Sato from Mace News, please.
Thank you, Governor. Earlier, we saw reports from Asia that semiconductor shortages have been largely resolved, but since global chip demand is recovering and we're seeing slower deliveries of cars and trucks, for example, and shipping companies are also diverting the routes to bypass some areas. So do you think this can be a sign that the global supply chain is not fully recovering from the impact of the pandemic and geopolitical events, and therefore adding upward pressures to prices in general?
Well, if you look in the section that describes the risks to our outlook, geopolitical tensions are one of those things, and the types of things that we're looking at are the things that you mentioned. Certainly, if there's further disruption to shipping lanes, or if some of the global tensions that we see now escalate, that could have an impact both on supply chains and on commodity prices. So it's definitely one of the risks. It's listed alongside housing prices that we were just asked about a few minutes ago.
Okay, so if I understand that answer correctly, it's basically, yeah, it's a risk. We disclosed it, and that's that. Yeah, so if we're being honest, I found that answer particularly weird. Like, what is that supposed to mean? We disclosed the risk, and that's that. Besides these huge glaring risks, we're still painting a rosy outlook, and just because we disclose these risks, we're gonna ignore them. I don't understand that. So in summary, we had another dog and pony show from the Bank of Canada. They delivered another spiel of yeah, things are gonna get better next year. And only talked about rate cuts. There was a lot of softball questions asked, basically pandering to that sentiment, saying, "Oh, are you really gonna cut rates soon?" Yes, we are. Are you gonna cut rates maybe in June after you see some data from 2 months more of data? Yeah, we are. So there was a lot of these softballs thrown at Tiff Macklem. I tried to pick out the questions that I thought were actually pretty good. I gotta give credit to the reporters. They kept their questions very, very respectful. I don't think I could have that level of tact if I had to ask Tiff Macklem questions. So good questions were asked, answers were provided, and those answers give you a lot of insight. First off, these guys, the Bank of Canada, are well aware that there is a huge risk of interest rates actually going up, not down. Those risks are mainly fueled by things like geopolitical tensions and things like that going on in the broader global economy. Also, I found it particularly interesting that they're trying to almost absolve themselves of what's going on in the interest rate market and therefore the real estate market. Yes, Tiff Macklem did concede that the real estate problem that we're having right now is quote unquote monetary policy working. That's how it works, he said. So that's him partially, I guess, accepting responsibility for this mess that is the housing and rental market in Canada. And when we talk about these things, it's really a chicken and an egg situation, right? Because inflation basically devalues your money. So when your money is devalued, tangible assets that are worth something, things like your house, they go up in value, right? So now you have to pay nominally a higher amount of dollars for it. But because your dollar is now worth less, it's not like actual wealth is being created. You can observe the same thing in the used car market. I often go in Auto Trader and Kijiji to check out used cars, and I can't believe it, but a 2010 Toyota Venza that I bought for $7,000 is now worth close to like $13,000. And this is all happening fundamentally because our currency is being devalued. I hope you enjoyed this episode, and I hope that somebody found it useful. Please don't forget to like, subscribe. This is a new channel. I need all the help I can get to get it off the ground, and I really appreciate any comments, likes, and subscriptions that you have. Thank you for watching, and I'll see you in the next episode.